Hi everyone, my name is Stephen Stewart. I'm the CEO of Orefinders Resources, and today we're going to try something a little bit different. We're presenting something called Inside Orefinders Gold plus our M&A Thesis. This whole talk is designed to give you an understanding of where we're coming from, how we see the market, both gold and M&I on the equity, junior equity side, and how we're going to participate on this. We think it's a very unique period in time, and we're looking forward to telling you a little bit about our perspective. So here is the forward-looking statement. It's ubiquitous. Every junior, every company has or should have one. The bottom line is investing in the exploration, development, and extraction industries is risky. But the same goes for Apple, Tesla, IBM, you name it. If you don't understand the risks, do not invest, and that goes for Orefinders as well. So why don't I tell you about those risks, but also more importantly, let's talk about the upside. And to do that, we have to explain, well, what is Orefinders? As you saw from our opening slide, we are exclusively gold and exclusively in the Abitibi. There is a very specific reason for that, and I'll get into that later in this talk. What else is Orefinders? Well, our management team has skin in the game. That is very important. Extremely important. If management doesn't have skin in the game, then their interests are not aligned with shareholders. We're also long-term investors. What we mean by that is this is a long-term business. We cannot get consumed with the day-to-day price action of the equity prices. That is, while always important, it's irrelevant to the decision-making process on a day-to-day basis. Third, we're growth-oriented. That goes for our projects. Obviously, we will not own or acquire any project that we do not see upside potential. That is our biggest optionality. That's why people invest in the juniors, is to the prospect of always being able to discover a new ore body or expand the existing one. So we're looking to expand our existing ones, but also acquire new opportunities. And we're built for upside, but we protect the downside. And what I mean by that is we are in a kid in a candy store right now, I could say. Very few people are caring about the industry, and to me, that's a screaming buy in terms of assets and opportunities. But we protect our downside. So what I mean by that is we're not spending big money on drill campaigns because nobody's caring. You're not getting paid for that risk you're taking. I'd rather spend the additional marginal dollar acquiring a known or an existing ore body rather than expanding ours, because we know ours isn't going anywhere. But when things are cheap, you might as well buy additional assets to grow your portfolio. So how I would sum Orefinders strategy up, which sort of encompasses all these 4 points, is that we focus on real value that can be built at the company level, not necessarily a value at the shareholder level or the share price level. Obviously, that is our main focus at the end of the day, is getting our per share price up. But how you do that is focusing on real value and then being able to be patient. And that's where the timing comes in. We do not control, or nor can we control, the macro element of the market. When the market will turn, that is beyond our control. But if we focus on the real value, we're very confident that the market will turn. And we're going to tell you why we think that is. And when it does, Orefinders is going to be in a fantastic position to take advantage of that upswing. So I said we are exclusively gold and in the Abitibi. Why are we so focused on these two things? Well, there's very good reasons. Our investment thesis is very simple. Gold is experiencing supply side issues. What I mean by that is there's less and less of it to be discovered. Certainly at these prices, the miners have been depleting their reserves without replenishing them. Their reserves, global reserves, are on the decline. In order to maintain their production portfolios, something's going to have to change. The market's not in equilibrium. Grades are going down. It's harder to find these new things. So there is a severe supply side issue on the horizon. That dovetails right into mergers and acquisitions. We see an M&A cycle on the horizon. Make no mistake about it. That's how the industry survives. That's how it will continue to survive. Large companies simply cannot discover the amount of gold on a per ounce basis that they produce on an annualized basis It's virtually impossible, and it's gotten even more difficult given the constraints that I just talked about, meaning that we're just not finding the big deposits anymore. And so when this M&A cycle does come, the demand for gold will be exceptional in Canada because everybody wants to do business in Canada. We've had our challenges, but I think the pendulum is swinging in the right direction. While on the other parts of the world, there's serious nationalization, resource nationalization going on. And so we think it's going to be especially focused in Canada. And when it does come to Canada, it's going to be magnified in the Abitibi because the Abitibi is really Canada on steroids, the best place in the world to do business. So to answer your question, why do we do gold in Abitibi? Because we see huge opportunity in gold, and it's going to be magnified in the Abitibi. So again, this is a bit of a reiteration, but just to be very clear, the miners are under intense pressure to replenish their depleting assets. And there's a bit of a fear of missing out human psychology that's going to go around. When this M&A rush does come, it's going to be very gradual. We're already seeing deals starting to happen. In fact, on an asset-to-asset, company-to-company basis, the industry is as busy as I've ever seen it. But that's going to grow. It's going to be gradual, and then it's going to be all of a sudden because the current production rates are just simply unsustainable. And once they see their peers doing deals, they're going to feel a lot of pressure to do so. And then there's limited supplies of assets in the existing pipeline. We're going to get more into detail of this, but we just happen to think that owning these future mines, the next generation of Canadian production, is going to provide exceptional leverage to the gold price, which itself we think is going to go up. So if Orefinders buys the right assets, supply squeeze is going to come. There's going to be a huge rush. Orefinders is going to get out. In fact, is already out in front of it when the M&A does come, and it is coming. So let's talk a little about the physical gold market, the supply and the demand side. Everybody sort of knows this 101 economics situation. Of course, the price would equal the equilibrium. When it comes to demand side, predicting the price of gold, it's absolutely impossible. And we always say, be cautious of anyone predicting what the gold price is going to be based on, interest rates, risk, et cetera, et cetera. The truth is, in the short term, nobody knows. They are just guessing. So be cautious of anybody who is predicting the gold price in the short term. They're probably trying to sell you something. However, in the medium to long term, we do see issues, and clearly those issues, as we discussed before, they actually stem from the supply side, which in itself is easier to understand because we can see the real data. We see the production profiles, we see the grades, we see the production or the discoveries, we see the M&A. There's just clearly a lot less of it being found and at a much lesser grade. So that is a supply side issue that will impact the price. Over the medium to long term, I emphasize the short term, there's just too many variables that can fly in the face of any one of these issues. But over the medium term, these fundamentals will prevail. Now let's talk about the demand side for gold junior equities. That is completely different, different market than the actual physical gold side. We've seen gold been strong, ever since the bloodbath, if you will, of 2015. The price of gold has been strong in American dollars. Let's just call it $1,300 Canadian at the 17. These miners are making money at these prices. If you can't, you should probably go into a different business. So I think the metal prices are strong, but the equity prices have not been reflected in that. So while we're sort of mid-cycle in terms of gold prices, I think we're at the bottom of the trough in terms of equity prices. Now, when it comes to the junior side of the business, they're still gun shy from 2015. A lot of money was lost, and that's because the industry under-delivered. It's as simple as that. And while there has been some recovery, the speculative investor, and that's a very, very important part of our industry, has fled. And they have fled to fast-moving, so-called sexy sectors, which would include the cannabis or the pot market, cryptocurrencies, blockchains, etc. So the people, and this is a proxy. Before I get into the speculative investor, this is exactly we have not delivered. Look at what's going on there. If you see, it's a 10-year chart of venture and the gold equities. we're just nowhere near where we used to be. And it's sort of been flat since 2015, even though you can see the trough there. It hasn't had the upsides, and that's because the speculative investor has fled and they've gone elsewhere. So who are these people? Who is the speculative investor? They are the people that take a small percentage of their portfolio, and they're not invested. In this particular part of their portfolio is not looking for 10% yields. They want 10 times returns. Let's face it, in the investing world, they take a little bit of a gamble. And that's fine, provided you understand the risks. These people are attracted to fast-moving, high-risk sectors, of which the exploration and development business falls right into play. These are our traditional life sources for capital. However, they've gone into pot and cryptocurrencies who have delivered in terms of return. Now, I do question the fundamentals of these industries, and I'll get into that, but that's where the money has gone. So that's why you see metal prices gone up, but equity prices have not, because there's just not an appetite from people looking to buy these equities. So, but I think this is going to change, and this is my, as I call the Simpleton's analysis of the pot stocks. If you look at the combined market cap of the 5 largest cannabis companies, over $15 billion. That is significant. But what are these businesses, or are they businesses, or are they just companies? In my opinion, most people, even though they have a $15 billion market cap, most people don't even know how they make money. Most of them will say, well, don't they just grow pot? Well, maybe they do. I don't know what these businesses do. But if they just grow businesses, if they just grow pot, aren't they just farmers in a very highly regulated, low margin, quasi-legal, and yet it's also a mature industry? It's not as if the pot smokers of the world is going to grow exponentially. No, this is a mature business. It's a low margin business. It happens to be new and sexy, and it's attracted a whole lot of money to the industry. I'll also note there's all sorts of, as I call them, financial shenanigans going on, and how these things get financed. But as long as the retail market continues to gobble them up, there's going to be all sorts of interesting financings done by very sophisticated capital, who very rarely lose money, and when these issues come out, very rarely have actual skin in the game. They usually have nothing but upside. But that's a story for another time. We think that when the dust settles in the pot industry, it'll be nothing but a low barrier to entry business model with no optionality. Certainly not optionality like the discovery of an ore body, which the mining industry does provide. So where's the money gone? Here's the money. Very clear. Look at all that capital. That capital used to flow into the mining business, flowed into the pot business. Is that good news for mining? No, it's not. But I really do believe that those days are numbered on the cannabis business. It's a sound business. Don't get me wrong. It just is very overvalued, and that will all revert to the mean. When, I can't say, but I have a good deal of confidence that day is coming. The second traction of capital as of late has been the crypto and the blockchain. Now, this is another Simpleton's analysis of it, but in my humble opinion, most of these cryptos, not all, most of these are essentially Ponzi schemes, whereas they have their business model is nothing more than the greater fool theory. They just think that somebody at a later date is going to end up paying more for that coin or whatever you want to call it than they paid. There's no fundamental business model other than that. It's a multi-level marketing scheme online, and it's been very popular. But I think that is actually already come down. I don't think anybody really is taking those. At least serious money is not really interested in that too much anymore. Blockchain, another sort of derivative of this crypto world. Blockchain is a very interesting technology, has huge applications. But you need a business. It's the technology itself isn't a business. You can apply blockchain into various capacities. But again, are these companies or just businesses? And if you see a blockchain mining company corp raising money, I suggest you turn and run. That's really not a fundamental value proposition in our opinion. So again, where is the money gone? The money's gone to blockchain, crypto. Look at these financings. Again, all of that money used to flow into mining. Now it's gone. That's the disconnect between strong metal prices and low equity metal prices. But again, I think the mean will revert, and most of this money will come back into mining. but not for no good reason. There has to be a reason. So as I say here, crypto is passe while cannabis smells like a bubble. That money's still going to want to invest. Speculative investor will eventually come back to the mining, but not on its own. We need to give them good reason to. And I think M&A is going to be that catalyst. It's as simple as that. When the market starts humming and the big guys start buying the other big guys, and then the mid-tier guys start merging, and then it all trickles down to the juniors. And that is going to create a lot of interest, and interest begets more interest, and then there you go. We begin the next cycle. So that's our fundamental thesis, is that the speculative money is going to come back to the industry, but it needs a reason to. But we've got a good reason. It's M&A, because the industry absolutely can't live without it, and it's coming. So everybody understands that mining is a depletion business. And what that means is that your mine is worth less today than it was worth yesterday, because you're mining it and selling it. So without replenishing your reserves, you're doomed for bankruptcy. Every mining CEO understands this. Most of the mining company big CEOs were replaced in the last cycle because they overpaid at the top of the cycle. The new cohort of CEOs are, again, like the investors from 2015, they're a little gun shy to make these moves. But I assure you, we are all, and they are all, subject to human psychology and the fear of missing out. Once they see their peers start buying, they will as well. They have no choice. Again, to repeat, the gold reserves have declined significantly. Their grades have gone down, and the rate of discovery has been nowhere near. And we've got some charts to show this. So, 5 years, it's just been very, very flat in the industry, and that all is going to come home to roost. So take a look at here. I know this chart's a little noisy, but what I want to refer you to is the green line. And this goes back to 1991. So this is a long-term chart, gives you a very good flavor of what's going on. And this is how many millions of ounces were discovered in that particular year. I mean, you can see back in the 90s, they were discovering over 100 million ounces a year. And that's what you need in order to feed the beasts that are Barrick or Newmont, these big, large companies who produce 5 million ounces a year. You need that kind of discovery in order to sustain it. But if you look throughout the 2000s, where money was going up and they're still making discoveries, then all of a sudden, come 2007, it's been a trickle, and the trickle's being generous. We are just not discovering the new ore bodies. And you can see it's not necessarily a function of lack of investment, because in 2011, that red line indicates investment. So there's absolutely a diminishing returns associated with going on. These things are becoming harder to find. We've found the easy ones. Now we have to start looking at being creative. These things are going deeper. We're going to have to mine lower grades. Many people are going to foreign jurisdictions, very risky jurisdictions. So we just have to dig deeper and look harder in order to find the gold. But we're certainly not finding it at the same rate. Now, to me, that means there's a price disequilibrium, which has to happen. If we want to hit those same production rates, there has to be an increase in gold in order for that to be justified. Here's just an example of grades. This is a little bit lesser of a chart, but does give a clear pattern of look, we were almost at 1 3/4 grams per ton, and now we're down to 1 1/4. So that's a fairly significant decline in gold grades that are going through the mills. That's 30-35% decrease in average grades. That's significant. That's a 35% decrease in revenues. And so this is an example I've used in the past, and I think it's actually quite relevant. Now, Barrick Gold, the largest gold producer in the world, has been for a long time. They are an industry leader, no doubt about it. They have some of the best mines in the world and some of the best and largest reserve portfolios in the world. And what they said at their annual general meeting earlier this year was that they do not intend to sell any assets to repay their debt. Now, what does that mean? That means that they have healed their balance sheets. They have recovered from the overvaluation acquisition cycle that they and others went through in the early 2010 cycle. And they are the leaders. So now they understand that it's not necessarily about replenishing their balance sheets, what they had to do, but it's about growth, sustaining their 5 million ounces a year or whatever production profile they have to do. If they want to do that, they need more projects. So They're not selling assets, so what does that mean? They're likely going to start buying assets. And when the leader does it, so do the others. So again, this is our part of our thesis of human psychology. As the leader goes, so does the others. When Barrick starts buying, it's going to be the trickle-down effect, and the trickle-down effect is going to come and play right into Orefinders' hands. So I emphasize, there's only two companies that make 5 million ounces a year, and that's Barrick and Newmont. That means between the two of them, they have to replace 10 million ounces of gold production, not just resource or reserve production, every single year. When you're not finding these monster deposits like we used to, what does that mean? Well, to me, that means one option: M&A. Barrick's production reserve trend, again, this is just I'm not picking on Barrick. I have the utmost respect for them. They are the industry leader, but look at their reserves, look at their production profile. It's coming down, as are their grades. They are a proxy of the industry as a whole, and everything is on its way down. And that could mean price increases, but certainly does mean M&A. So one topic I hear around a lot is peak gold, and quite frankly, we just feel that is invalid. Peak gold assumes price is static, and it is not static. I think to discuss peak gold, you have to put it in the context of price. So if you say $1,300 per peak gold, well, sure, we probably are near peak gold there, but the demand dictates further growth. The world wants the gold, and therefore there's going to be a demand for supply, and in order to do that, the price is going to have to snap out of equilibrium. The gold price is very dynamic. So, gold, while it is scarce, it's one of the most scarcest commodities in the world. It's actually abundant. So there's 20 million pounds in the ocean. If we wanted to mine the ocean, we could do so, but gold price would obviously have to be significantly higher. So again, just a little point of clarification, there's lots of gold out there. It just, in order to find it, we have to be more creative, dig deeper, or mine lower grades. In order to do that, what do you need? Higher prices. Okay, now shifting back into sort of out of the macro and more into the micro, at least specific to Orefinders. And again, why do we like Canada? Well, quite simply, it's the best mining jurisdiction in Canada. The political pendulum is swinging back. And what do we mean by that? Well, as we all know, in Canada, we've had issues developing our resources, whether that's the oil and the pipelines or the ring of fire. But I think the political appetite for taking on these projects is changing. There's been certainly a vocal minority who have been anti-development anything, but I think the silent majority, if you will, is taking control back. And so when you mitigate those issues, Canada certainly, we're the best place to do business. What are the alternatives? The DRC, Mexico, Mali, etc. There's many, many others, all having security or resource nationalization issues. The companies that have their flagships or serious operations there are all looking at or in the process of coming back to Canada to diversify that risk. So M&A is coming. It's going to come back to Canada even more so. We've got very sound laws. We've got established geology. We understand it. The infrastructure is there, certainly in a good part of the area. So it's just a good place to do business, and we're quite comfortable there. When you look at Canada, we're actually, not a huge player on the gold space, but it doesn't totally intuitively make sense to me. You see China, Australia, Russia, and the United States are all ahead of us. But Canada's the largest company short of Russia. We're the largest country in the world. We should be right up there producing just the same amount as China. We certainly have the potential to do so. It has nothing to do with our geology. In fact, we probably have better geology than China, but it's a function of investment and discovery and political appetite. So the moral of this slide is really, as Canada has a long way to go in terms of growth in its gold potential. If you go north of Timmins, exploration just doesn't happen too much. But I assure you, even though there's not a lot of head frames up there, it's really a function of access to roads and whatnot, and that's going to be changing. So again, Canada is a great place to do business. It's a mature mining industry, but it has a long way to grow. I mean, we're just ahead of Peru, and we have as good, if not better, geology, and certainly a much, much larger landmass. So why the Abitibi? The Abitibi is probably top 2, top 3 geological belts in the entire world. The Witwatersrand probably stands alone, but other than that, the Abitibi is one of the best places in the world to find minerals, gold being one of them, one of the major, if not the major. It's been mined since 1901. It'll be mined for another 100 years and beyond, no question about it. Why do we like it? Well, we understand the geology. The geology in the Abitibi and the Greenstone Belt there is very different than the Carlin Trend. It's very different than the Witwatersrand. We wouldn't be as good at doing at what we did if we were in those other jurisdictions. So we stick to what we know. Not only do we understand the rocks, we know the stakeholders, First Nations, provinces, local communities, and of course the owners of the asset, which is very, very important. We've got a good reputation. People understand us, and I think they like doing business with us, and that will pay dividends for any future acquisitions we have. Of course, the Abitibi has access to infrastructure. I think that is key. We can, all in, we can do drilling $100 to $150 per meter. If you want to do it in the Arctic, up there, it's $1,000 a meter. That adds up. You want to do, 3 holes of 1,000 meters, that's $1 million for 3 holes. We can do it here for a fraction of that cost. Plus, our people can go home at night. We don't have to build camps. We don't have to build roads. The infrastructure is right there. Certainly when it comes to Orefinders assets and anything that we would look at in the future, we can drive to them. You can take your Honda Civic right to these things. It really makes a difference in terms of ease and access of operations. So the moral of the story, as I said before, when the M&A rush does come to Canada or to the industry, Canada is going to be getting a premium because that's where most are going to want to come. And when you say Canada, it's a big place. Abitibi is a small place within it. The Abitibi is Canada on steroids, and the intensity of the acquisition, and hence the price that people are going to be willing to pay for these assets, are going to be that much higher than anywhere else in the world. Other point I want to make about technology, or specific to the Abitibi, is in my mind, in our mind, in Orefinders' mind, the next big thing coming to the mining industry in terms of an evolution or a revolution is big data. That is the future. Mining's mature. We're probably not going to mine it too differently over the next, couple decades. How we find it is going to change dramatically. And what I mean by that is taking the data, layering on machine learning and algorithms to spot patterns faster. Because at the end of the day, that's all that geologists do. They spot patterns in data, whether it's visual data or numerical data, that's what they do. But with the introduction of these sophisticated computers, cheap computing power, and programs and algorithms designed to effectively mimic what geologists can do, this is a game changer. Now, I'm certainly not advocating the replacement of geologists. Far from it. You need a human component, if nothing to oversee it, but just sort of to guide the whole program. But these geologists become much more effective with these new tools. But these tools are useless. Algorithms and machines are useless without the data. Now, I emphasize this. The Abitibi has over 120 years worth of data. You want to go to the Arctic, nowhere near that sort of data. You want to go to West Africa, forget about it. Doesn't exist. This is one of the biggest upside potentials to the Abitibi, is the data available. There's publicly available data, but there's also a lot of proprietary data. And that is something that Orefinders is paying a lot of attention to. We call it our Moneyball exploration. It's a proprietary program where we take gigabytes, in fact, I should say terabytes worth of data, and we layer it and we sift through it, and we are using that give us an edge, because that's all. There's no guarantees, but it gives us an edge and it lowers our cost of capital and our chances of success. So this, not just specific to Orefinders, but this big data in general is a major thing, but you need the data, and the Abitibi's got it. So here's the Abitibi, very briefly. These are all sorts of fantastic mines here, head frame after head frame, whether it's the 101 or the 66 in Kirkland Lake. They're just pilfered with head frames, producing mines as well as former producing mines. Orefinders, as it stands right now, has 3 assets in a very tight radius, all close to Kirkland Lake. And these are all fantastic assets, each of which have numerous former producing mines, established and known geology, and most importantly, big upside potential, which we understand and have a plan to work towards. Where is the best place to find a mine? This is the old adage, it's beside an existing one, or in the shadow of a head frame, as they say. And we say, no, that's probably the second best place. The best place to find a mine is on an old mine. Why? Because we know the geology. There's been extensive drilling. We understand the ore body as it was or as it is. We understand the metallurgy. There's a lot of data and drilling, etc. Sometimes we can go underground. And what's very important, again, ties back into the data, is there's new interpretations of this. There's new ways of looking at it. Computer programs are better, smarter, etc. But also new ways of looking through human interpretation is important. This model is proven. This is not proprietary to Orefinders. We're not inventing the wheel. We're borrowing from those who have been successful in the past. And here's a perfect example. These are all new interpretations of old mines. Barrick, Goldstrike. Goldstrike on its own created Barrick, still in production these days. It also created Franco-Nevada. This one mine alone created two of the biggest precious metals companies in the world, one of the best assets ever discovered. It was at one time an old mine valued at $1, owned by Joe Rodman. As I said, it's now created Franco-Nevada and Barrick. Red Lake, everybody knows this story. It was a very, very marginal mine until they used sort of first generation computer analytics. We're probably now at third generation computer analytics, but they used that and created Goldcorp, which was at the time one of Canada's largest mines, certainly its highest grade. The Malartic, which is Osisko Ebb, most people know this story. Old high-grade underground mine acquired for $80,000. Sean and John and Bob did a fantastic job, sold this for $4 billion. Pretty good return. Same thing with Detour. Old high-grade underground mine, looked at in different context. Same thing with the Richmont and the Iron, the island, which is actually now owned by Alamos. Fairly ho-hum mine until they discovered a new ore body directly underneath it. And I guess the most recent example would be the Integra Gold, which is the Sigma and Lamac. Bought it out of bankruptcy for 6.5, discovered the new Triangle Zone, which was right underneath their nose. And again, this has to do with data and new interpretations, and they sold that for a nice return of almost 100 times their money, or at least their original acquisition cost. So this is the model that Orefinders sticks to: is, hey, let's look for old mines that have new ways of looking at it. And I'll remind you, we did this on the Cote Lake project, which was eventually sold to IAMGOLD for $650 million in 2012. That was a former producing mine, but that was, again, high-grade underground that ultimately will become a low-grade open pit. So again, different way of looking at something old. So why Orefinders? We are built for patience because we believe timing is everything, and we can't control the macro side. So how are we patient? Because we have a low cash burn. We're very prudent with how we take in money and also how we spend it. We're not looking at massively dilutive situations. We're certainly not focused on spinning the drill at this point in time because the market is just not caring for that, and that's a very risky proposition. Again, we'd rather spend that marginal dollar acquiring additional assets and growing our portfolio as opposed to doing high-risk drill programs that nobody really cares about unless you find a discovery of a lifetime, and we don't like those odds. So what else are we? Built for patience. We own our assets. We have no debt, and they are not optioned. So that is very important when you're doing your comparative due diligence between Orefinders and anyone else. Please look at their balance sheet. Do they actually own their assets outright? Are they patented claims? All these things matter. If they're not, they may lose their properties. If they're option payments, they may owe millions of dollars on these properties in order for them to execute that. Orefinders is not in that situation. Our assets are not going anywhere anytime soon, or unless we want them to. And we'll note that everything is for sale at all times, but it's a function of price, and we are buyers, not sellers in this market. And why else Orefinders? Because we have 3 high-quality AAA Abitibi real estate projects in our McGarry, our Murado, and our Knight projects. I'm not going to get into detail about the minutia and why these projects are so fantastic. That's for another time and another presentation, but we have really, really great assets that are not going anywhere. We will own them when the market turns. And and that's why we're being patient. So, said I wouldn't say much about our assets, I won't, but just remember, a few things is one, the McGarry mine, a beautiful mine. Those grades speak for themselves. There's established resource. It was in production as recently as 2013. Very accretive transaction for us. The Knight project has some of the highest grade gold intersections in Canadian history and sits on top of a 4 million ounce deposit owned by a major mining company. That is a consolidation area. We see that as Cote Lake Part 2, but in the making. The Murado project, that's what most people know Orefinders for. Fantastic little cash flow generating opportunity there. We're working hard to get the toll milling situation worked out and move that forward. Once that's organized, we will have the ability to generate our own cash flow, and we will not be at the mercy of the markets and the equity markets and the prices. And of course, Power Ore is officially spin off. It's its own separate entity, but Orefinders holds a very significant equity position in that. We are long-term holders of Power Ore because we believe in the battery metal and the electric vehicle story. So that is basically just flows to our liquidity. It's a nice cash equivalent to have on our balance sheet. So other than that, that's it. Thank you for your time. Again, my name is Stephen Stewart. You can reach me anytime. My email, my phone number is there. I always respond, and I look forward to hearing from shareholders or interested parties. So until then, thank you and have a good day.